Lesson 5. Accessing your money, early surrender penalties, and liquidity limits. Welcome back. In the last lesson, we talked about the fees, rules, and changing terms found in annuity contracts. Now we need to answer a very practical question. What happens if you need your money back sooner than expected? Maybe you have an unexpected medical expense. Maybe your home needs a major repair. Maybe your financial situation changes. Or maybe you simply decide that the annuity is no longer right for you. An annuity may allow you to withdraw your money, but early access can come with costs and restrictions. That is why annuities are usually considered long-term financial products. Today, we are going to talk about what I call the fine print with teeth: surrender charges, withdrawal limits, market value adjustments, and possible tax consequences. This may sound complicated, but we'll take it one step at a time. Before we discuss surrender charges, let's define an important word: liquidity. Liquidity simply means how quickly and easily you can turn an asset into spendable cash. Money in a checking account is highly liquid. You can normally use it right away. Money tied up in real estate is less liquid because selling a home or property takes time. An annuity may fall somewhere in between. You can often request a withdrawal, but the insurance company may limit how much you can take without a charge. The contract may also include rules that reduce your account value or future benefits when you withdraw money. So the question is not only, can I get my money? You should also ask, how much can I get? How long will it take? And what will it cost me? A surrender charge is a fee the insurance company may assess when you withdraw too much money during the early years of the contract. The period when this fee may apply is called the surrender period. A surrender period may last 5, 7, 10, or even more years. The length depends on the contract. The charge usually begins at a higher percentage and then falls over time. For example, a surrender schedule might look like this: 8% in year 1, 7% in year 2, 6% in year 3, and then 1 percentage point less each year until the charge reaches 0. That is only an example. Some schedules stay at the same percentage for several years before they begin to decline. Others may last much longer. You need to review the exact schedule in the contract you are considering. Let's look at a simple example. Suppose you place $100,000 into an annuity. The contract allows you to withdraw 10% of the account value each year without a surrender charge. That means you may be able to withdraw $10,000 without paying the contract's surrender charge. Now, suppose you withdraw $50,000 during the first year when the surrender charge is 8%. The first $10,000 may qualify as a free withdrawal. That leaves $40,000 subject to the surrender charge. 8% of $40,000 is $3,200. In this example, the insurance company would deduct a $3,200 surrender charge. You could also owe income taxes and possibly an additional federal tax. We will discuss those tax consequences in a moment. Remember that this example is only an illustration. Your contract may calculate the charge differently. Not every insurance company calculates surrender charges in the same way. A charge might be based on the amount you withdraw, the amount of premium connected to the withdrawal, the amount above your free withdrawal limit, or another formula described in the contract. Some surrender schedules also restart when you make a new contribution. For example, your original deposit may be past its surrender period, while a newer deposit may still have several years remaining. Ask the seller exactly how is the surrender charge calculated, and does each new contribution begin a new surrender period? Do not settle for a general answer. Ask to see the rule in the contract. Many annuities allow you to withdraw a limited amount each year without paying a surrender charge. This is commonly called the free withdrawal provision. 10% is common, but it is not a universal rule. The free amount may be based on your original premium, your current account value, your value at the beginning of the contract year, or another number defined in the contract. Some contracts do not allow a free withdrawal during the first year. Others allow withdrawals only after the first contract anniversary. The unused amount may not carry forward. For example, if you do not use your 10% withdrawal this year, you may not receive a 20% free withdrawal next year. The rules vary, so ask, how much can I withdraw without a surrender charge? When does that right begin? What value is used to calculate the free amount? And does an unused withdrawal amount carry forward? Here is an important distinction. A free withdrawal normally means that the insurance company will not apply its surrender charge to that amount. It does not necessarily mean the withdrawal has no other consequences. A withdrawal may still create taxable income, be subject to an additional federal tax, reduce your account value, lower your death benefit, reduce a guaranteed income benefit, reduce the value of a premium bonus, or affect the amount you may withdraw in future years. Some annuities also include a market value adjustment, often shortened to MVA. A market value adjustment may apply when you withdraw money during the surrender period. It is usually connected to changes in interest rates since you purchased the annuity. The exact formula will be written in the contract. A market value adjustment can be positive or negative. That means it could increase the amount you receive or reduce it. In general, when current interest rates are higher than they were when you purchased the annuity, the adjustment may reduce your surrender value. When current interest rates are lower, the adjustment may increase your value, but you should not rely on that general rule alone. Every contract has its own formula. The market value adjustment may apply in addition to a surrender charge. In some contracts, it might even apply to a withdrawal that is otherwise free from a surrender charge. Ask, does this contract include a market value adjustment? When does it apply? And can you show me examples of both a positive and a negative adjustment? Now let's talk about taxes. This is where people sometimes confuse two completely separate costs. The surrender charge comes from the insurance contract. The federal tax rules come from the Internal Revenue Code. You may face one, both, or neither. In general, when money is distributed from a deferred annuity before you reach age 59 and a half, the taxable portion may be subject to an additional 10% federal tax. That additional tax is separate from regular income tax. However, it usually applies only to the taxable portion of the distribution, not to money that is considered a tax-free return of your original investment. The tax treatment also depends on where the annuity is held. A qualified annuity is generally held inside a tax-advantaged retirement account, such as a traditional IRA or an employer retirement plan. A non-qualified annuity is purchased outside a retirement account, usually with money that has already been taxed. Let's put the pieces together. Suppose a person under age 59 and a half withdraws money from an annuity during the surrender period. That person might face a surrender charge from the insurance company, a negative market value adjustment, regular income tax on the taxable portion, and an additional 10% federal tax on the taxable portion, unless an exception applies. These costs may occur at the same time. That does not mean every early withdrawal will result in all four. It means you should understand the complete effect before requesting the money. Some annuity contracts may waive surrender charges under certain conditions. Possible waivers may include the owner's death, a terminal illness, confinement in a nursing home, a serious medical condition, extended hospitalization, or another qualifying hardship. These waivers are not automatic or identical across contracts. The contract will define which situations qualify, how long you must own the contract before the waiver becomes available, what medical proof is required, and how much money you may withdraw. Most annuity contracts include a period during which you may review the contract after receiving it. This is often called the free look period. During this time, you may generally cancel the contract without paying a surrender charge. Use this period carefully. Do not place the contract in a drawer and forget about it. Read the contract. Compare it with what you were told. Review the fees, guarantees, surrender schedule, withdrawal rules, and changing terms. Contact the insurance company directly if anything is unclear. If the contract does not match your understanding, act before the free look period ends. This lesson brings us back to an important planning principle. Do not place money into a long-term annuity if you are likely to need that money for short-term expenses. Before purchasing an annuity, you should generally have enough liquid savings for emergencies and expected major expenses. That might include money for home repairs, medical bills, a replacement vehicle, taxes, travel, or other spending you expect during the surrender period. An annuity should normally be funded with money you can leave invested for the length of the contract. No interest rate, bonus, or income benefit is worth creating a cash flow crisis. Before purchasing an annuity, make sure you can answer these questions. How long is the surrender period? What is the surrender charge each year? How is the charge calculated? Does each new contribution have its own schedule? How much can I withdraw without a surrender charge? When do free withdrawals begin? Does the contract include a market value adjustment? Could a withdrawal reduce my income or death benefit? Could the company take back part of a bonus? Are surrender charges waived under certain conditions? How long is the free look period? And most importantly, could I leave this money untouched for the full surrender period? If the answer to that final question is no, the annuity may not be the right place for that money. You did excellent work today. In Lesson 6, we are going to turn our attention to the insurance company itself. An annuity guarantee is only as dependable as the company making the promise. We will look at financial strength ratings and what they mean. I'll see you in Lesson 6.